Well, welcome to Trading in Self-Isolation, traders. Today, we're going to take a little bit of a change of tact. Rather than necessarily go through the fundamental finite points, which I don't think are as relevant. We know that the world's going to see a poor Q1 and an awful Q2. But today we're looking more at what the market's expecting for the week ahead, in terms of the implied movement. If we can understand implied movement, we can make a really clear assessment about our risk, and we can make a much clearer assessment about our position sizing, which of course is so important in this market. When you've got high implied volatility, you have to be adjusting your position size if you're going to survive and thrive in this market going forward. It's been a messy week so far. I'm saying this before non-farm payrolls numbers, although I think the last 2 weeks of jobless claims will feed into the April numbers, so I don't want to say they're irrelevant, but I think in terms of the market pricing, they shouldn't be too much of a market catalyst there. But we've got our eyes very much on the case count, and I think that's really continued to be the number one predominant driver of the variance in these financial markets. But let's have a look at what the market's expecting, and let's have a look at the boards here. Okay, let's see how major currencies have fared over the last 5 days. So you've got the NOK, which has been the superstar, up 0.8%. Obviously a reflection of the short covering we've been seeing in Brent prices, which we'll touch on in a second, WTI. You've got the high beta currencies, the Real, Peso and Rand getting pretty badly beaten up. Shouldn't necessarily surprise too much, given that vols are still pretty high across multi-asset markets there. And you've got euro dollar down 2.7%. That's been a big well traded by clients this week, and big driver of the variance of the dollar index. Aussie dollar down 1.9%, one that we'll focus on in a second. But let's have a look at that dollar, because that's one that really fascinates me at the moment. You saw that big move up in the dollar index through that period of uncertainty where equity markets were badly beaten up, high yield credit spreads widening substantially. Everyone wanted dollars in that situation, specifically from EM, with the dollar swap lines coming through, going out to a major number of central banks, and obviously QE Infinity. We saw the dollar give way pretty sharply there, but we're still seeing a re-emergence of this dollar flow trade that we're seeing. Maybe that's coming from EM. You've seen those outflows from EM funds, both bond and equity markets. It looks like the dollar is effectively the new toilet roll again if we got that move higher. So if we get that rate of change kicking in and that dollar moving back up into, say, 102 region, and maybe even threatening to take out those recent highs, then I think risk assets could come under a bit of pressure. One chart we're looking at pretty closely, which could determine that move in the dollar, is what's happening in dollar CNH. It's a chart I put out yesterday in Trading in Isolation. So you saw that move up that we saw up here. Generally, these things sort of kick on in the direction of the flow. We're seeing that consolidation in this period around here, sort of into sort of 112, oscillating around there. If this break to the upside, that will be respected, and I think that should be respected, and I think that will impact dollar flows into things like the Aussie dollar. I think Aussie dollar will roll over. Things like cable will come under pressure. Euro dollar will probably roll over, and that dollar will continue to move up pretty sharply. There's a lot of correlations between dollar CNH and other dollar pairs as well, so if that dollar breaks the upside, that could have big implications there as well. Have a look at cable, because that's another one that's consolidating in this kind of box area that you've been seeing. So there's a bit of indecision from the market. The bulls aren't prepared to take too much risk on and push this higher, but let the market compel you here. If that breaks the upside, then I'd be looking to take on positions, and potentially we could make a move back into sort of 128, 130 region. Obviously, if we take out these lows around here, that could be an opportunity for markets to roll over a bit there as well. Have a look at Euro Aussie, because I think that's an interesting chart. You've got markets grinding lower. Does this break to the upside, or do we actually see prices really roll over? At the moment, it's just grinding up. This needs to make its mind. So again, we're just looking at markets that might necessarily, you have to deal at straight away, but could compel you going forward. And also that chart of WTI is really interesting there, because you've got that price just refusing to break through $20 or close there on a convincing basis. Short covering play through there. If you look at managed money, long short positions, that ratio has come right back, and therefore I think you've seen a lot of short covering playing through. I'm not prepared to chase the oil market there. So if you're a CAD trader and you're looking at WTI or Canadian Sands or whatever you're looking at, I wouldn't necessarily be prepared to trace here. I think this is more a demand issue for me, and you're going to see about 14 million barrels per day of demand giving way in Q2 year on year, that figure is. And therefore, I think just cutting supply is not necessarily going to work too well. And I think you've got to see the US involved, Mexico, Canada, and everyone coming through. And previous production cuts didn't necessarily work too well anyway. But let's see how this all sort of staggers into vols for this week. If you have a look at this column here, you can see 1 week implied vols, 1 week, 1 month implied vols, and you can see the actual at the money implied vols playing through here. So I think these numbers they're certainly elevated. If you look at 24% in Aussie yen, you can see the range that we've been in 52 week, 4.72 to 57.34. Aussie dollar, which you can see is one of the highest ones there. So it's the Antipodean currencies which have got the highest implied volatility. So if you are looking for price moves, if you're trading the Antipodeans, just be aware that you potentially could get some extended price moves this week, and that needs to be respected in terms of where your stop's going to be and your position size in the market. Have a look at Aussie dollar, 23%. So we trade up at the 46% at 404. I think I've got a chart which I can show you here. Yeah, so this is the Aussie dollar one. You can see Aussie dollar 1 week implied vol. You can see it trading right up into that 46% level. We've come right back down to 23%. It looks remarkably like the volatility index of the S&P, the VIX there, but we're still not out of the woods by any means at all. We'll talk about the expected move that's playing through. If you have a look at risk reversals, which I think are really interesting as well, they've come back to much more normal levels there. Gold, cable and dollar yen, they've come back to more normal levels. You can see there dollar yen risk reversals 1 week, so the skew of volatility, or the put volatility, trading at a premium free vols over calls. It's not by extreme by any means. We were down at -9, so that was where put volatility was trading at 9 vol premium to call volatility, and the market was betting that we were going to see extreme downside playing through. But what does that all mean for the week ahead? Let's have a look at my spreadsheet to get a sense of what we're seeing there. With those implied volatilities which we saw, you can see Aussie CAD 16.3%. When you put that into the Black-Scholes formula with other factors, you can see that the expected move over the coming 5 days, 172 pips, which gives you a range of 87.30, 83.86 from current spot prices. You can see Aussie yen 23%. Again, current prices, that gives you a 190 pip move. There's your kind of implied range that we're going seeing. Euro dollar, well, we've got the implied volatility at 11.3%, which gives you a 140 point move up or down. So the expected range with a 68.2% level of certainty there, or confidence, is 109.96, 107.14. And dollar yen, which has come and settled down a little bit now, down into 14%, 193 point move, which, to give in perspective, is the range. So I put a little playbook out there, and you can see those expected move, 193 points, gives you this kind of move here. Now, I like to use that as my guide for how much risk I'm taking on. If you look at a 10 delta strangle, which gives you a bit more of an outlier, the market's saying there's a 10% probability we could get up to here. These are the kind of levels we're into, sort of 111, 105 kind of regions there. So volatility has come down a little bit, but you can see the expected move up or down from current spot price. And if you're trading off daily charts or 4 hour charts, I think that's really, really interesting. So not a lot to really necessarily look at as we're going through the new week. Really looking at those vols and how that means for your position size. They are elevated. Potentially they can come down a bit, but we'll have to see. Trade these FX moves with Pepperstone.